You probably haven't looked at your bank's fee schedule since the day you opened the account. Most people never do. You picked a bank because it was convenient. Maybe it was the one near your college, the one your parents used, the one with the app that looked fine. And then you never thought about it again, because nothing about a bank account feels like it requires ongoing attention. It just sits there, holding your money, doing its job. Here's the thing most people miss, though. The most expensive thing your bank might be doing to you isn't charging you a fee at all. It's quietly paying you almost nothing on money that could be earning hundreds of dollars a year somewhere else. That's the strange part about this entire topic. The biggest cost on this list often isn't something taken from you. It's something that simply never arrives. And on top of that, there are usually a handful of smaller, more direct costs stacked on. Fees designed to be easy to miss, not through one obvious charge you'd notice and complain about, but through several small ones that individually feel too minor to investigate and collectively add up to real money every single year. Some estimates suggest the average American pays somewhere in the range of $150 to $300 a year in avoidable bank fees. And that figure doesn't even include the interest being left on the table, which is often the larger cost of the two. None of this requires you to have done anything wrong. It often just requires having an account with fees or features that no longer fit how you use your money, which is a more common situation than most people realize. Today, I'm walking through exactly where this money goes, the specific fees, the interest you're not earning, the small design choices that push you towards spending you didn't plan for, and what to actually do about each one. None of this requires switching your entire financial life overnight. Most of it requires about 20 minutes and a willingness to actually look at the terms of an account you've probably never read closely. Let's start with the monthly maintenance fee, because it's the most straightforward one and also the easiest to eliminate entirely. Many checking accounts charge somewhere between $5 and $15 a month just to exist, unless you meet a specific requirement: a minimum balance, a certain number of direct deposits, a minimum number of debit card transactions. On the surface, this looks avoidable, and technically it is. But a huge number of people paying this fee aren't failing to meet the requirement on purpose. They just don't know the requirement exists because it's buried in a disclosure document nobody reads when they open the account. Run the math on this. $12 a month in maintenance fees is $144 a year. Over 10 years, assuming you never noticed and never switched, that's $1,440. Money paid for literally nothing, in exchange for a service that dozens of banks, particularly online ones, provide for completely free. This is the easiest fee on this entire list to eliminate, because eliminating it doesn't require behavior change. It just requires either meeting a requirement you didn't know existed or switching to an account that doesn't have one at all. The second cost is overdraft fees, and this one is more insidious because it's specifically designed to feel like your fault rather than an account design choice. Here's how it typically works. Your balance gets low. A transaction comes through that would put you below zero. Instead of simply declining the transaction the way a debit card arguably should when there isn't enough money, many banks will approve it anyway, and then charge you somewhere between $30 and $35 for the privilege of letting you spend money you didn't have. Let's walk through exactly how this compounds, because it rarely happens just once. Say your balance is sitting at $18 on a Tuesday. A $25 subscription renews that you forgot about, a transaction that exceeds what's actually in your account. Instead of declining it, the bank covers the extra $7 and charges you $35 for doing so, putting you at negative $42. 2 days later, before you've noticed what happened, a $15 grocery purchase goes through, gets covered the same way, and adds another $35 fee, putting you at negative $92. By the time you check your account and realize what's happening, you're not down the original $25 subscription or the $15 groceries. You're down $70 in fees alone, on top of the $40 you actually spent. A swing of $110 from where you started, created almost entirely by an overdraft policy that helped you spend money you didn't have, twice without asking. This sounds like a convenience, the bank covering you so your card doesn't get declined at the register. But the actual economics are brutal. If you overdraft on a $4 coffee, you're not paying $4. You're paying $4 plus a fee that's roughly 7 to 8 times the size of the purchase itself. According to data from the Consumer Financial Protection Bureau, Americans pay billions of dollars in overdraft fees every single year, and the accounts that pay the most in these fees tend to belong to people who can least afford to be losing money this way, which is precisely the problem with a fee structure that profits more from people with less of a buffer. Most banks now offer a setting that simply declines a transaction if you don't have the funds, instead of covering it and charging you for the cover. This single setting, buried in your account preferences, can eliminate this entire category of cost. A declined transaction at the register is mildly embarrassing. A $35 fee on a $4 coffee is a genuinely bad trade, and it's one you can opt out of in most cases with a few taps in your banking app. The third cost is ATM fees, and this one is almost comically avoidable once you actually notice it happening. Using an ATM outside your bank's network typically costs you twice, once from your own bank for going out of network, and once from the ATM's owner for using their machine. Combined, this often lands somewhere between $4 and $6 per withdrawal. Here's where this becomes a bigger number than it feels like in the moment. If you're withdrawing cash from an out-of-network ATM twice a month at $5 a transaction, that's $10 a month or $120 a year. Again, for something that costs you nothing if you simply plan slightly ahead, using your own bank's ATM network or getting cash back at a store you're already shopping at. This fee is almost purely a tax on not thinking about it in advance, which makes it one of the easier ones to eliminate once you're aware it's happening. The fourth cost is the one I mentioned at the very start, and it deserves a full breakdown because it's usually the largest one on this entire list: the interest you're not earning. This is the opportunity cost of keeping your money in a low-yield or non-yield-bearing account when a better option exists for the exact same safety and access. Let's actually run this comparison because the gap is larger than most people assume. Say you keep $10,000 across checking and savings combined, a reasonable number for someone with some emergency savings built up. If that money is sitting in a traditional bank's savings account, earning close to 0.05% annually, you're earning about $5 a year on that $10,000. If that same $10,000 were sitting in a high-yield savings account earning a competitive rate, you could be earning several $100s a year instead, sometimes $400 or more, depending on current rates. That's not a rounding difference. That's real money you're simply not collecting every single year for holding your money in one type of account instead of another that offers identical safety. Now let's look at this same gap at a smaller balance, because this isn't only a problem for people with large savings. Say instead you're keeping $2,000 in savings, a realistic number for someone just starting to build a cushion. At 0.05% in a traditional account, that's about $1 a year in interest. At a competitive high-yield rate, that same $2,000 could earn somewhere around $80 a year instead. It's a smaller dollar amount than the $10,000 example, but the ratio is identical. You're leaving the vast majority of the available interest on the table regardless of how much you have saved, simply by keeping it in the wrong account type. This cost is invisible specifically because it never shows up as a charge. Nothing gets deducted. No notification pops up. The money just quietly fails to grow the way it could have, year after year. And most people never notice because there's no moment where the bank explicitly takes something from you. It's a cost of omission, not a cost of action, which makes it the easiest one on this entire list to overlook, and, ironically, often the largest one in dollar terms. Notice something about all four of these so far. None of them are huge on their own. A $12 fee doesn't feel like theft. A missed $80 in interest doesn't feel like anything at all, because nothing was visibly taken from you. That's exactly why people keep paying them, year after year, without ever stopping to add it up. Let's keep going, because there are a few more worth knowing about. The fifth cost is foreign transaction fees, and this one matters more than people expect, even if they don't consider themselves frequent international spenders. Many credit and debit cards charge somewhere between 1% and 3% on any purchase made in a foreign currency, or on transactions processed outside the United States, depending on your card's specific terms. If you travel internationally, even occasionally, this fee can quietly apply without you fully realizing why a charge came in slightly higher than expected. On a $3,000 international trip, a 3% foreign transaction fee is $90, purely for the privilege of your card working in a different country. Cards specifically designed without this fee exist, many of them free, and switching to one before a trip or simply as your everyday card, if this applies to you regularly, eliminates this cost permanently going forward. The sixth cost is one that's grown significantly in the last several years, and it's the quiet expansion of convenience fees attached to features that used to be free. Paper statement fees, fees for a physical card replacement, fees for expedited transfers that used to be standard and are now upsold as a premium option. Individually, these look like nothing, $2 here, $5 there. But they represent a pattern of monetizing things that were previously just part of having an account, and they tend to specifically apply to the customers least likely to notice or complain, because they're small enough to feel not worth the friction of disputing. The seventh cost is one of the least visible on this entire list, and it's the way some savings accounts quietly tier their interest rate based on requirements you may not be meeting without realizing it. Some accounts, including a portion of those marketed as high yield, reserve their advertised top rate for balances above a certain threshold, or for customers who also maintain a linked checking account, or who meet some other requirement buried in the account terms. This isn't the norm. A single rate across your full balance is more common, especially among competitive online savings accounts, but it's common enough to be worth a quick check. Here's how this plays out in practice when it does apply. Say an account advertises a competitive rate up to a certain percentage, but that top rate only applies to the first $10,000 in the account, with any balance above that reverting to a much lower rate. Someone who built their savings past that threshold, assuming their entire balance was earning the advertised rate, could be earning meaningfully less on the excess than they believe they are, sometimes not realizing it for years, because the account statement doesn't necessarily spell out which rate applied to which portion of the balance. This is worth checking specifically if your savings account has grown significantly since you opened it, because the terms that applied at a lower balance may not be the terms currently applying to your money. Add all 7 of these up and the picture becomes clear. A monthly maintenance fee at $144 a year. 2 overdrafts compounding into roughly $70 in fees alone, which is common for people living close to the edge of their balance some months. A TM fees at $120 a year. Foregone interest on $10,000 sitting in the wrong account type, conservatively $300 to $400 a year. That's already approaching $650 a year in costs that require no lifestyle change to eliminate. Not less spending, not more income, just a different set of accounts and a few settings changed. Let's talk about how to actually fix each of these, because identifying the cost doesn't help unless you know the specific action that eliminates each one. For the maintenance fee, check your bank's fee schedule directly, which is usually available in your account terms or by asking a representative directly. If there's a requirement you're not meeting, a minimum balance, a direct deposit threshold, either meet it or move to an account, often at an online bank, with no such fee at all. This alone can save $100 to $150 a year with a single phone call or a single account switch. For overdraft fees, go into your account settings and opt out of overdraft coverage, choosing instead to have transactions simply decline if there isn't enough money in the account. This one change can eliminate an entire category of cost that specifically preys on people already living close to their balance, and it's usually a toggle you can find in under 2 minutes inside your banking app. For ATM fees, locate your bank's in-network ATMs in the areas you frequent, or default to getting cash back during a purchase at a store instead of paying a withdrawal fee. If you travel or live somewhere without convenient in-network access, consider an account specifically designed to reimburse ATM fees, which several online banks offer as a standard feature. For the interest you're not earning, this is the highest leverage fix on the entire list relative to the effort required. Opening a high-yield savings account takes about 15 minutes online, and moving your emergency fund and any other cash savings there instead of a traditional low-yield account can be worth hundreds of dollars a year in interest you're now actually earning instead of leaving on the table. For foreign transaction fees, if you travel internationally with any regularity, look specifically for a card that advertises no foreign transaction fees. This is a common enough feature now that finding one requires almost no sacrifice in terms of other card benefits. For the smaller convenience fees, the fix is simply awareness. Read your bank's fee schedule once, in full, even though it's tedious. Most people have never done this even once since opening their account, and it's the single fastest way to find out exactly which of these costs currently applies to you specifically. For the tiered interest rate issue, check the specific terms of your savings account, not just the headline rate advertised on the homepage. Look for language about balance thresholds or linked account requirements, and confirm your entire balance is actually earning the rate you believe it's earning, especially if your savings have grown substantially since you opened the account. Here's exactly how to put all of this into action, broken down by timeline. This week, pull up your bank's actual fee schedule and read through it once, fully, noting every fee that currently applies to your account. Also this week, check your overdraft settings and switch to decline instead of cover if that option exists and isn't already selected, and check the specific terms on your savings account to confirm which rate actually applies to your balance. This month, if any of your savings is sitting in a low-yield traditional account, open a high-yield savings account and move it over. This is the single largest dollar-for-dollar fix on this entire list relative to how little effort it requires, and it's worth doing even if your balance is small, because the ratio of interest gained holds regardless of the amount. This quarter, if you regularly pay ATM fees or you travel internationally with any frequency, research and switch to a card or account specifically designed to eliminate whichever of those costs applies to your situation. Once a year, going forward, revisit your bank's fee schedule the same way you just did today, because banks periodically add or adjust fees, and a schedule that looked fine last year isn't guaranteed to look the same today. This is also a good moment to double-check that any tiered interest rate you're earning still covers your full balance, especially if your savings have grown since your last review. None of this requires switching your entire financial life or becoming someone who obsesses over banking minutiae. It requires one afternoon of attention to a document you've probably never opened, followed by a handful of settings changes and possibly one new account. The gap between someone quietly losing $650 a year to their bank and someone who isn't was never about income or discipline. It was about whether anyone ever stopped to actually look at what their bank account was doing in the background. And now you have.